Explore the critical decisions, inherent risks, and essential controls that govern how organizations acquire goods and services. The expenditure cycle transforms simple purchase requests into formal, legally binding commitments with financial consequences. Management must balance inventory optimization, supplier selection, and cash flow timing across every transaction. Align operational needs with rigorous financial safeguards to ensure no dollar is spent without proper authorization. User departments initiate a purchase requisition, a formal internal document requesting specific materials or services needed for operations. Procurement managers validate the need and confirm budgetary alignment before approving any request. Ordering unnecessary items or missing volume consolidation opportunities could yield better supplier pricing. Once a requisition is approved, the purchasing department selects a vendor and issues a formal purchase order, a legally binding commitment to buy at specified terms. Vendor kickbacks and inflated prices are among the most common threats at this stage. Using a pre-screened supplier registry prevents unauthorized purchasing from unapproved sources. Requiring multiple bids for large orders drives fair pricing and reduces favoritism. Strict policies banning vendor gifts protect procurement staff from conflicts of interest. Receiving staff compare the physical shipment against the open purchase order on file. Staff receive POS with quantities hidden, forcing a true physical count rather than assuming delivered amounts. The ordering function and the receiving function must be performed by separate individuals to prevent collusion. Accounts payable performs a three-way match, ensuring the purchase order, receiving report, and vendor invoice before any payment is made. Duplicate payments, vendor fraud, and unauthorized payments are mitigated. Invoice versus PO match, invoice versus RR match, and PO versus RR match are crucial to ensure no errors occur. Authorized cashiers release funds only upon receiving a fully approved voucher package. This is the final and most sensitive stage of the expenditure cycle. Misappropriation of cash is the highest stakes threat in the entire cycle. Restrict access to check signing machines and electronic transfer terminals to authorized personnel only. Require 2 authorized signatures for disbursements above a defined dollar threshold. An independent party performs monthly reconciliation to detect unauthorized transfers or alterations. Enterprise systems replace paper trails entirely, flagging mismatches, blocking duplicate invoices, and routing approvals automatically in real time. Automated identification technologies eliminate manual entry errors at receiving, improving accuracy and speed. The shift from periodic audits to constant, data-driven vendor performance monitoring closes gaps before they become losses. Auditors focus on the completeness of liabilities, ensuring every obligation is recorded, especially near year-end when cutoff errors are most likely. Examine unmatched receiving reports in the days surrounding year-end to surface obligations that haven't yet been invoiced. Every authorization, approval, and disbursement must be time-stamped and stored in a tamper-evident, secure system. Internal control is not a one-time setup. It is a continuously evolving defense against fraud, error, and inefficiency. Ensure no single individual controls requesting, approving, receiving, and paying for goods. Maintain complete, accurate records at every stage, from requisition to final disbursement. Every transaction must carry a clear, traceable approval before any payment is authorized. Leverage ERP analytics and independent review to identify and close control gaps before they cause harm.